March 2025. A solar panel manufacturer in Germany suddenly cancels orders. A defense contractor in Virginia adds silver to its strategic reserve. 3 Asian refineries stop accepting new contracts. And in London, the world's oldest bullion dealer implements purchase limits for the first time in over 340 years. This is not tomorrow's news. It is happening right now. If you don't understand what these signals mean, get ready to witness the largest industrial commodity crisis of the 21st century unfolding in real time. In the next 12 minutes, I will explain the 3-step lockdown pattern that precedes every critical resource shortage in history. Strategic stockpiling, export restrictions, price controls. This happened with oil in 1973, with rare earth metals in 2010, with semiconductors in 2021, and now it is happening with silver. What makes this time different is the absence of substitutes, bypasses, or technological fixes. When the lockdown completes, entire industries come to a halt. Let's begin with phase 1, silent accumulation. During this stage, governments and corporations quietly buy silver without announcements or triggering panic. For example, China stopped publishing import data for silver at the end of 2023. Why does that matter? Because a country consuming 1/5 of the global supply is hiding its purchases. In 2024, India's silver imports hit a 38-year high. Not for jewelry, but for strategic reserves classified alongside military assets. That treatment is reserved for weapons, not industrial metals. Meanwhile, Russia diverted 100% of its domestic silver production to state reserves starting early 2024, neither selling nor exporting. At the same time, the United States, the birthplace of modern finance and global trade leader, has no strategic silver reserve left. The U.S. sold all its stocks between 2005 and 2015, betting on paper markets and unlimited supply. While China, Russia, and India accumulated physical silver, America did the opposite. Now look at corporate behavior. Tesla secured fixed-price contracts for 7 years of silver supply in 2024, locking in metal before the shortage. First Solar, Panasonic, LG, and Samsung signed similar long-term deals directly with mines, bypassing the spot market. When top manufacturers hoard metal, they are reacting to data most do not see. This is phase 1, accumulation without panic. The smart money is already positioned. The question is, are you? Phase 2 is export restrictions and capital controls. Countries protect domestic supply by blocking or limiting exports. The reasons vary: national security, environmental concerns, industrial policy, but the outcome is the same. Supply fragments, global markets break, prices diverge. Recall when Indonesia, the world's 4th largest tin producer, banned tin exports in 2013 until prices stabilized. Tin prices doubled and dependent industries faced shortages. The rare earth crisis in 2010 saw China restrict exports officially for environmental reasons, but really to secure metals for electric vehicles, wind turbines, and advanced missiles. Prices surged tenfold in 18 months. Japan and the US scrambled to stockpile and reopen mines, which takes years. The damage was done. What is happening now with silver? Russia banned silver exports to sanctioned countries in 2022. Mexico, the world's largest silver producer, imposed export quotas in late 2024. Peru tightened regulations, slowing silver mining just as demand soared. Coincidence? Doubtful. 4 South Korean banks stopped selling physical silver in February 2025, not by choice, but because they could not source metal. When banks with seemingly unlimited capital cannot get physical silver, that signals real scarcity. China barred citizens from buying precious metals through banks, raising risk classifications and restricting platforms, likely to prevent competition with state accumulation. This is phase 2, market fragmentation. Nations keep silver domestic, exports dry up, global markets falter. And once phase 2 is underway, phase 3 is inevitable. Phase 3 is price controls and rationing, the endgame. Governments and exchanges panic, imposing controls and shattering the illusion of free markets. It is not if, but when. Historical examples are clear. In 1971, President Nixon closed the gold window because gold reserves ran low. The fixed price of $35 an ounce exploded to $850 by 1980. Not mere inflation, but a price dislocation. The paper system broke. Physical owners won. In 1981, the Hunt brothers accumulated 200 million ounces of silver and demanded physical delivery. Vaults emptied. The COMEX raised margin requirements, banned new long positions, and halted trading. The Hunts were destroyed, but physical holders continued winning even as prices crashed on paper from $40 to $10. The lesson: systems change rules, but cannot confiscate physical metal. In 2001, Russia delayed palladium shipments, causing metal to vanish and prices to spike to $1,000 per ounce. Exchanges forcibly settled contracts in cash, inconveniencing paper holders. Physical holders profited enormously. Now look at silver today. COMEX registered inventories tumbled from 100 million ounces just a few years ago to under 40 million now, a 60% drop. Industrial demand alone is over 1 billion ounces annually. Total inventories equal only 3 weeks of consumption. When shortages surface and manufacturers announce supply issues, panic will cascade. Governments stockpile strategically. Investment demand explodes. The paper market will collapse. Here is what full phase 3 looks like. Trading halts become common. COMEX suspends physical delivery. SLV, the largest silver ETF, switches to cash settlements due to unavailable metal. Shares no longer represent silver, but only dollars worth far less silver than when purchased. Governments impose price ceilings to manage panic, sparking black markets with multiples above official rates. Rationing prioritizes defense contractors, solar panel makers, electronics producers, while retail buyers find empty shelves, 2-year mint backlogs, and premiums $100 above spot prices. The spot price no longer reflects reality. This is not hype, but pattern recognition. Why is silver different now? Every past resource crisis had an escape. Saudis pumped more oil. Rare earths found new sources. Semiconductor fabs were built. Silver has no escape hatch. Supply is structurally capped. About 70% of silver is a byproduct of zinc, copper, and lead mining. You cannot mine silver directly. You rely on base metals, which have weak prices, deterring investment. New mines take at least 10 years. There's no time to wait. The deficit is immediate. Recycling will not fix this. Recovery from electronics is under 20%. Extraction is expensive, and solar panels lock silver for at least 25 years, effectively sidelining it. Substitution does not exist. Copper oxidizes. Aluminium cannot match conductivity. All major solar manufacturers have tried and failed. Silver paste remains the only scalable option. Demand is legally mandated. The European Union, China, and the United States have committed trillions to the energy transition, requiring solar installations to double by 2030 to meet climate goals. This demand is not market-driven, it is policy-driven. Policy does not care if silver costs $30, $60, or $150 per ounce. Buyers must comply while supply runs out. The oil crisis in 1973 was solved by pumping more oil and new sources like the North Sea coming online, then demand moderated. Crisis over. The silver crisis of 2025 has no Saudi Arabia, no giant undiscovered deposit, and no demand reduction since legislation requires continuous buying. This is the first modern resource crisis without a structural fix, only a violent price adjustment. What does this mean for you? I'm not telling you to panic. I'm telling you to recognize reality. Phase 1 is complete. Countries and corporations are stockpiling. Phase 2 is active. Export restrictions are spreading, fragmenting supply. Phase 3 looms. The paper market is borrowing time. Understand this. Once Phase 3 activates, price won't matter. Silver will become unavailable at any price. Dealers will be sold out. Mints will have year-long backlogs. Banks will stop selling. You will be left holding depreciating currency, unable to convert it into the only asset preserving value. The window to act is now. Not next month, not when headlines confirm this. By then, premiums will be $50 over spot and physical supply impossible to find. The crowd will panic. You will compete with millions who just realized the truth. Hold physical silver in your possession, not an ETF, not a certificate, not in someone else's vault, but in your hand, immune to counterparty failure, government restriction, or forced cash settlement. Only this position survives Phase 3. This is not investment advice. This is pattern recognition. I have shown you the 3 phases: silent accumulation, export restrictions, price controls and rationing. I have shown you historical precedents: oil, rare earths, palladium, gold, and why silver today is different. No substitute, no new supply, no escape hatch. The lockdown has begun. Countries are securing supply. Corporations are hoarding. The average person remains unaware of what is coming. Don't be average. Don't wait for confirmation. Verify this yourself. Check COMEX inventories. Review export data. Study corporate supply chain disclosures. It is all public and documented. When you see Phase 2 accelerating and Phase 3 approaching, you will understand this is not hype. It is the greatest resource lockdown of the modern era. No one is ready. Subscribe and turn on notifications. What happens next will determine who prepared and who did not. Those who recognize the pattern early will not just survive, but thrive. The clock is ticking. The lockdown has begun. The question is, will you act before the window closes? Don't be everyone else.